So today and tomorrow, we are going to be studying market analysis, and it's in two parts. We're going to do a look at macroeconomics today, and then tomorrow we're going to look at industry analysis and company analysis. So I'll just get going here. So general issues in economics, how businesses allocate scarce resources, restrictions on plant, labor, equipment, etc. So in a capitalistic economy, prices are influenced by market structure, regulation, a few other things. Closed economies severely limit trade with the outside world. This is like North Korea. In a mixed economy, some state-owned, some private, I'd say China is more a mixed economy. Global markets, organizations generally can market and sell products and services around the world. Think of oil. Countries have a natural advantage in labor, raw materials, or technology. So, some of the Asian countries have an advantage in cheap labor. U.S. has an advantage in technology. Russia, raw material, maybe. Flow of international trade can be interrupted by many factors, and some of them have been in the news: embargoes, quotas, tariffs, government subsidies, etc. And there's a term called dumping, which is the illegal practice of selling a product in another country at prices below or sold in the home country or below cost. So number of years, 5 or 6 years ago, China was busy dumping aluminum into the US. And they weren't subsidizing the aluminum specifically, but they were subsidizing the power to the aluminum companies. And that's the biggest expense in making aluminum. So the US dollar has been the world's reserve currency since World War II. This keeps the dollar very high because other countries keep their monetary reserves in dollars. So if you're China and you've got excess income due to a high trade balance, you got to do something with that extra yuan. And usually what they're going to do is they're going to park it in US Treasury bonds because they're considered to be the safest investment in the world, or risk-free. Transportation trends. It's useful to understand the impact of cost changes. Overcapacity in the container, air freight, and sea freight markets has led to several mergers and acquisitions. This happened a few years back. High oil prices have resulted in higher costs, cost-cutting measures by the transport companies, and congestion in the ports, especially LA, has extended lead times. You got government policies, monetary and fiscal policies, along with laws and regulations. And in some of these third world African countries, you got instability politically. World industrial migration. So there are certain industries that chase the cheap labor rates, textiles for one. Import and export issues. These have been in the news lately: tariffs, quotas, embargoes, and environmental concerns, hazardous waste, CO2 emissions, land use and control of commercial operations, etc. So the next concept is balance of payments. So the balance of payments is kind of like the report card for the country. Summarizes all the transactions that a country's individuals, companies, and government bodies complete with others outside of the country. So it's made up of two accounts. The balance of payment has two accounts: a current account and a capital account. So the current account is the nation's transactions with the rest of the world in goods and services. This is what you usually hear about a lot: a trade surplus or deficit. Net trade and services is often referred to as the invisible trade surplus or deficit, and net earnings on cross-border investments and transfer payments, etc. This is what's been in the news, and what President Trump was trying to affect was the trade deficit that the United States has in goods and services with the rest of the world. The other half of it, that's the current account, trade in goods and trade in services. The other half of it is the capital accounts. So the capital accounts keep track of net change in the nation's assets and liabilities during the year. So it'll indicate whether a country is importing or exporting capital in this investment. Importing means more capital is flowing into the country than going out, caused by an increase in foreign ownership of domestic assets, people buying U.S. Treasury bonds, basically. And that's external borrowings from the U.S. And big changes in capital account can indicate how attractive a country is to foreign investors and can have a substantial effect on exchange rates. So the US dollar will get stronger, which attracts more capital on this side. And trade restrictions help make the US count a positive. So if you want to drive this positive, you're going to drop the value of your dollar, which is going to drive this negative. So it's kind of a yin and a yang thing. So the trade and the deficit is only half of the solution. I mean, you got all these investments in the capital account, which, it should be a balance of payments. It should sum to zero. Countries run large trade deficits in the current account deficit, like the United States, also should run large capital account surpluses. So the capital account measures the changes in the national ownership of assets, and the current account measures the country's net income. So here's the current account. And this goes back to like 1995. Here's 2022. And the trade deficit keeps getting bigger and bigger. But here's the capital account. And it's negative also most of the time, except for we get these spikes. And why that is, it shouldn't be, but it is. You'd have to ask an economist, and you'll probably get 15 different reasons on why. I mean, this should be positive because this is negative. But the United States being the world's reserve currency just seems like the laws of economics don't apply to us currently. We'll see what happens in the future. Anyway, balance of payments affects the value of the dollar, which affects imports and exports. Now I want to move to the business cycle. These are the swings in the domestic economy, and PACCAR, being a cyclical, mature business, is very much affected by the business cycle. So it has 4 phases: contraction or shrinking of the economy, recovery or resuming growth path, expansion beyond the previous high, and slowdown or decline in growth. So you can look at it. Here's expansion. You're climbing the mountain, you get to a peak, and you go to contraction, and you hit a trough, then you start climbing the other mountain. So over here, here's the recession or a low where you're then you start expanding again, you hit a peak, then you go back through a trough. This is the recovery, trough, recovery. But each time the lows are a little bit higher and the highs are a little bit higher, so you trend up. Overlaid on this pattern is long-term economic growth, or long-term economic trends and seasonal patterns. So this is the long-term economic trend here, the green line. And business cycle forecasting models rely on leading indicators such as employment report, average hours worked, stock prices, construction starts, etc. So this is what the business cycle looks like. You got 4 phases: contraction, recovery, expansion, slowdown. And the way to kind of tell where you're at is to measure the financial markets. So in contraction, you're below capacity and declining. What you see is GDP dropping. GDP is the blue line, gross domestic product. And when you get near the bottom, bond interest rates will peak and start to come down, the interest rate. So the interest rate moves the opposite direction of the price of the bond. And then once you start to move into recovery, you'll see stock prices start to bottom and move up. And then commodity prices will start to bottom and move up. At that time, you see the Federal Reserve begin to raise interest rates because you're starting to see inflation. Once the Fed does that, bond interest rates bottom, and then stock interest, because the bond interest rates are going up, stock prices will peak and start to drop, and then eventually we'll move into a recession and the commodity prices will peak. And then the Fed starts lowering rates. So the way to kind of track all this, bond prices are a proxy for interest rates, and you can look at them here. This thing will ever load. You're on one day here, but we want to look at more like 3 years. So you can see here's 3 years, and you can also look at all the data, which goes back quite a ways. But you can see we bottomed somewhere in 20, mid 20, and interest rates have been heading up ever since. So clearly, we're looking at interest rates. Interest rates have peaked, and we bottomed somewhere in here. So here's the interest rate bottom here. And now we're kind of moving up. Then if you go and look at, I guess I want to go back here. Stocks, we can do the same thing. And look at something more than one day. Look at 3 years. So stocks for 3 years, we were on an uptrend to about 22, and now we're just kind of going sideways. But if we go back quite a ways, you can see that from January 80, January 10, we've kind of been on an uptrend, and now we're just kind of traveling sideways. So stocks probably haven't peaked. We're probably, in here. Here's where stock prices peak in the slowdown. So we're probably in this expansion phase here. And the last thing to look at is commodities, which you can see from commodities here. We'll look at a 5-year trend. We started up in 20 about the time we started interest rates started going up. And then we're kind of doing like the stock market. We're kind of going sideways. So commodity prices probably haven't peaked either, which is going to put us, in this area of this expansion. What does that mean? It means, sooner or later, we're going to hit this peak and things are going to start to go down, but we don't know when that is going to be. This is the problem with business cycle forecasting. You're in here somewhere, but it could be 10 months, it could be 10 years before you start down on the other side. There's no way to really tell. If you could, all these forecasters would be sitting on the beach, sipping Mai Tais, playing the stock market, and they're all still working for a living. So the other thing to look at is the yield curve. This is the yield curve today. It's a friggin' mess. This is what's known as an inverted yield curve. What you got here is 2-month, 3-month treasuries. Down here are 20-year, 30-year treasuries, and here's the interest rates. If we go back to 2017, that's what the yield curve is supposed to look like when it's healthy. The short maturities are at a lower interest rate than the longer maturities because you're taking more risk with a longer maturity. So you get paid more higher interest rate. But as you can see, over the last 5 years or so, things have just been getting weirder and weirder, where it started to flatten and then it started to invert till we get to where we are today. And it's just weird. So what that usually means is we've got a recession coming, but not always. So if we look at this, it's going to go like this. The red line is the federal funds rate. Blue line's 10-year treasury, green line's 2-year treasury. So where you see this red line on top, this is a well-inverted yield curve. And what it tells you is that when that happens, you're almost always got a recession coming your way. But not, every recession has been preceded by an inverted yield curve, but not every inverted yield curve has led to a recession. They're correlated by about a 0.8. So it's a pretty high correlation, but it could be anywhere between 3 months and 2 years before we see any kind of recession. And we don't know whether the recession is going to be a deep one, a long one, short one, shallow one. It's hard to say. All you know is the yield curve's messed up, and look out below. The other thing is the financial press has been predicting a recession for a year now, and it's probably the most widely predicted recession ever. And the financial press is never right about those kind of things. So we may have a recession coming, but it's not going to look like what everybody thinks it's going to look like in the financial press. That's pretty much a guarantee. And PACCAR being the cyclical business that it is, if there is a recession, it's usually affected, and our order board drops away pretty quickly. One of the other things you can look at is the ISM report on business. The prices paid and the employment are kind of indicators of recessions or inflation. And if you go into the break room where the coffee's at, the fridge, it's posted there on the bulletin board. Then a little bit on market structure. There's some types of competition in the market. There's monopoly, which is one provider of a product with many buyers. Most of the time it's illegal under antitrust law, although we do have some regulated monopolies, such as electric power. There's monopolistic competition, which is many sellers and many buyers. So this is like breakfast cereal, shoes, clothing. There's a lot of sellers and there's a lot of buyers, but the sellers create this illusion of very little competition through product differentiation. So branding, that's monopolistic competition. Oligopolistic competition is there's only a few sellers and there's many buyers. And the price is controlled by industry leaders or cartels. This is the oil markets worldwide. Barriers to entry are high, which limits the sellers. Examples are US Steel, in the early 20th century, OPEC automobile companies and airlines. Then there's perfect competition. It's a homogeneous product. All firms offer the same good with the same characteristics and quality as others. This is the commodity markets. So a bushel of corn is a grade of corn, and it's all the same for everybody that's offering that grade of corn. Large number of agents, so that nobody can really corner the market. There's too many buyers and sellers, and no entry or exit barriers. That's perfect competition. And a monopsony is the opposite of a monopoly. Several sellers, but only one buyer. Usually the government's the buyer, it's the nationalized railroads, it's phone companies, military fighter jets, etc. That's a monopsony. There's one major employer and many workers seeking to gain employment in a geographical area. That's also a monopsony, a coal miner area or something. All right. So a supplier wants to increase the term of a new long-term agreement, and you are currently negotiating from 3 to 5 years. Current interest rates are falling because U.S. Federal Reserve is actively reducing the federal funds rate. So the opposite of today, they're dropping interest rates. And bond prices look like they are no longer dropping and beginning to bottom, which means the interest rates are peaking. What should you do with the term of the LTA? So, where are you at in the market? You've got interest rates peaking. You're sitting in here somewhere. So what do you guys want to do? Any guesses? If you're at the bottom, prices are probably pretty low and you're not seeing inflation yet. So you probably want to lock in. Yeah, go long. Provided you got a fixed price contract, which we almost never have. Yep. Extend the price and go out as far as possible because you can lock in lower rates, hopefully. All right. There's 5 questions out there. Why don't you guys go get on them, and we'll cover them in about 5 minutes because we're running out of time. Or just raise your hand when you get done. All right, let's go over some answers here. Come on. Hmm. Okay. Number one is option B, because a balance of payment trade, earnings, and strength of economy have greater impacts on the U.S. than does tourism. Two is also B. The question stated the price of U.S. Treasury and corporate bonds beginning to rise would put you in either phase 1 or 2, slide 5. Business cycle phases. So 3 is going to be Charlie. Balance of payments requires the capital account to zero out the current account. So if the current account is in a surplus status, capital account must be in a deficit. 4 is Delta. Monopolistic competition. There are many sellers and many buyers, but the sellers try to create the illusion of very little competition through branding. And 5 is Alpha, because from the data that is given in the question stem, the economy is likely in phase 2 recovery. What you can expect to see in phase 2 are stock and bond prices continuing to rise, with interest rates dropping initially. Commodity prices will then start to rise, and the Federal Reserve will begin to raise short-term interest rates. All right. Any questions?
Are there more questions?
Yeah, but we'll get to them tomorrow. 6 to
Okay.
10 we'll do tomorrow. That's more on industry analysis. All right. Talk to you guys tomorrow then.
Thank you.
Thanks.
Yeah.
Thank you.
Thanks, Rick.
Bye. Bye.